Alright guys, welcome back to the channel. This is going to be a video that you probably don't see much of, but it's about time that I kind of shared this information with you, and it's really the secret to accelerated profitable trading. And before I get into it, I want to let you know that what to expect from this video, okay? So this is the type of video that people don't want to see much of because it's really just the truth. It's the truth about how professional traders develop profitable systems and how you can maximize returns, how you can accelerate returns on your system that's producing a profit already. And I'm going to go through the importance of what to look for first, how to build on that, and the importance of having the numbers. So let's get stuck in. So the first thing I want to let you know is that I've been around a lot of traders, okay, and I know many traders who have a very high strike rate in their trading system but have low profits as a result of a poor money management system. And I also know people who have a very low strike rate who are profitable due to a very good money management system. So what I'm going to share with you in this video is how to know where you are on the scheme of things in terms of profitability and how you can apply a money management system, which really is the secret, like the golden goose to making your system extremely profitable. This is what all the pros do. And I'm going to share that with you. All right, before we get stuck into the money management side of things, I want you to understand these three key principles that you must understand and must be done in order for you to have a wildly profitable trading system. Okay, the first one is you need to understand how to determine whether or not your system produces a positive expectancy. If it has a positive expectancy, great. If it doesn't, then you're actually on the wrong side of the fence, and that can have a detrimental effect when you start to apply money management. You can't apply money management to a system that's broken, and if you don't know that it's broken, it's actually going to fuel the fire. So it will make you go broke quicker. The second thing you need to understand is you need to be able to consistently trade that system with a positive expectancy time after time after time, focusing on profits over time. And then the third thing is that's when you add money management. It's the last thing you do. It's not the first thing, it's the last thing. And the reason it's the last thing is because I just said, if you don't know it's profitable and then you're unable to trade it, what's the point in adding money management to it? It's just going to have the opposite effect on your trading system overall. The next thing I want to share with you is just some common misconceptions, because I've seen people thinking that they should focus on the strategy and that's the main thing, and that's not the main thing. The strategy is not the main thing. I've always said, just assume every strategy that you come across is broken and try to make it profitable. And the reason I say that, which will come very apparent as I go into this video, is, the strategy is like 10% of your trading. It's literally just a set of rules that are forever changing in the market, okay? And your job as a trader is to earn a profit from a set of rules. And if the rules are always changing and the market's changing, then you need to be able to adapt and know how to adapt so that you're self-sufficient. The next misconception is the whole confusion between risk management and money management, okay? So I want to clear that up right now. There's a big difference between risk management and money management, and people kind of couple them together, and it's not the same thing. Risk management is the process of ensuring you are never at risk of exceeding your maximum allowable drawdown limit. And money management is the act of increasing or decreasing a position size to create maximum returns with the lowest possible drawdown. So those are the differences, and they're quite fundamental differences, they're very clear differences. So they're not the same thing. So what is positive expectancy? Because that's what we need. We need positive expectancy. It's the first thing we're looking for in our system. What is that? Well, simply put, positive expectancy is a mathematical proven probability that a trader will end up with a profit over a loss. And that is it. So no fluff, no kind of finger in the air type stuff. This is a mathematical proven formula. And I don't know about you, but I don't like to leave anything in my investing to chance. I have clear objectives and I have clear sets of rules and I have clear forecasts and I have clear results, and I know how to track metrics, and I want to see results. I want to see growth. I don't base anything off of opinions or feelings or finger in the air. It's not my style, and I don't think it's anyone's style, particularly any other professional traders that I've met or worked with in the past. So it's a mathematical proven probability that we're working to. So if that's mathematically proven, what is the formula? Well, it looks like this. 1 plus W divided by L multiplied by P minus 1. Now you're probably asking yourself, well, what the hell does all that stand for? You know, what are these numbers? So I'm going to give you an example here. The W stands for your average win, okay? And the L stands for your average loss. So let's just say that your average win is 200 and your average loss is 170. Well, if we put that into the formula here, we're going to have 1.18. And if we add the 1 to that, that makes it 2.18. Now, that means that we've got 2.8 multiplied by P. Well, what's P? P is the percentage of time that you are right. You've heard me say this before, you know, how much do I win when I'm right? How much do I lose when I'm wrong? And how often am I right? Those three things are what we're focusing on here. And P is the percentage of time that you are right. So let's just say you're a 55% trader, which means you've got a strike rate of 55%, which is about average, okay? You can look at this chart here, you can see that in the ballpark of that midpoint there, we're about 55% trader, where we've got just 1-to-1, just over a 1-to-1 risk reward. Most of the traders fit inside that 55% strike rate. So if we take our formula again here and we say 2.18 multiplied by 0.55, which is 55%, well, that equals 1.2. So if we now just take away the 1, which is the final part of the equation, we're left with 0.2. So what does that mean? Well, in order for your system to have a positive expectancy, the number must be above 0. And the greater the number above 0, the better the system. So you can see the importance of understanding this stuff, right? You can see that how this really blows any kind of concept of not needing to backtest or anything like that out of the window. It's just completely ridiculous, because if we don't understand these numbers, we've got nothing to work from in the first place. We've got nothing. We're extremely limited because we can't apply money management. And the way we apply money management is first understanding the ins and outs of the system. Not only just for the strike rate, but look what it's going to do for your mindset and your mentality and the psychology and the mental benefits of being able to have that information at hand when you go live into the markets. You know, there's going to be time, if you don't have that, there's going to be times when you want to jeopardize the system or you want to break the system. And you've got to understand that actually when you go out into the live markets, there's also the need for some wiggle room, because, you know, we all make mistakes. And I'm telling you, when you back test, you don't make those mistakes. When you've tested, you've got in at the right time, out of the right time, you've got, you know, everything goes to plan. It's like a bench test. In the real world, you're going to make some mistakes. You're going to mess up an order level. You're going to miss a trade. You've probably done this, right? We've all done this. So what the positive expectancy does, and applying money management to it, is it allows you to build wiggle room as well. And the way you do that is by saying, once you've got the figure and you understand how much profit you're likely to gain from that system, well, then you can say, would I be happy with half of that profit? All right, and if the answer is yes, then great. But if the answer is no, then you've got to go back to your system and make some tweaks and changes to increase that positive expectancy figure. So once you've got the figure that you want, the positive expectancy figure that you want, and it's, you know, way above 0 or above 0 at least, then you can start applying money management. You can say, okay, right, I know that it produces a positive expectancy. Now I can apply a money management system to that. And I'm going to explain exactly the different types of money management systems in another video. And I'm also going to do a video on risk management alone, because that deserves its own video. But I thought I'd share this with you so that you understand the first stages of building a really successful system that you can add accelerated money management systems to. Because without this, you won't be able to do that. You simply won't be able to do that. So I hope you found that valuable, guys. As I say, not many people know this stuff. It blows my mind that people don't apply this to their trading, but share it around. If you got value, let us know. Put some comments in the comment section and I'll engage with you down there. And don't forget to like the channel if you haven't already. I've got a plan to hit 50,000 subscribers by the end of the year, and we're very, very close. So I appreciate your help there, guys. Until next time, take care, have a great rest of your day, and I'll see you then.